In this video, we will focus on Ind AS 8 accounting policies, changes in accounting estimates, and errors. Before we begin, let me clarify that this Ind AS deals with four issues. First, selection and application of accounting policies. Second, accounting for changes in accounting policies. Third, changes in accounting estimates. And fourth, correction of prior period errors. Please note the tax effects of these four items are covered by Ind AS 12 income taxes. The definition paragraphs of this standard define terms such as accounting policies, change in accounting estimate, prior period errors, and materiality. Now, let's discuss accounting policies. Ind AS 8 states that accounting policies selected for every item shall be in accordance with Indian accounting standards. However, in absence of Ind AS that specifically applies to a particular transaction, the management must develop its own accounting policy that would result in presenting information in such a manner that is relevant for decision making and reliable. While creating its own accounting policy, management shall refer to three things. First, requirements of Ind AS while dealing with similar transaction. Second, framework, that is conceptual framework. And third, pronouncements of IASB. Ind AS 8 also requires us to apply accounting policies consistently once they have been selected, unless Ind AS specifically requires or permits to apply separate accounting policies to different categories of an item. So when can entity change its accounting policy? Entity can change its accounting policy only when either it is required by Ind AS or change would result in financial statements providing more reliable and relevant information. Please note 2 points. Application of an accounting policy for a transaction that differs in substance from other transactions, or application of new policy for transactions that did not occur earlier, is not a change in accounting policy. When an entity changes its accounting policy, such change shall be applied retrospectively. We have discussed the application of changes in accounting policy, limitations, and disclosure requirements in detail in our videos on Ind AS 8. Let's move on to changes in accounting estimates. Please note that a change in accounting estimate is not the same as change in accounting policy or correction of prior period errors. A change in accounting estimate can be on account of inherent uncertainties in business or change in circumstance on which an estimate was based. The effect of change in accounting estimate is to be applied prospectively, and the effect has to be included in the profit or loss of the current and future periods. Ind AS 8 also states that if it is not possible to differentiate between a change in accounting policy and change in accounting estimate, such change shall be treated as change in estimate. Like I said earlier, we have discussed each of these concepts in detail in our videos on Ind AS 8. Moving on, let's talk about errors. Ind AS 8 requires an entity to correct material prior period errors retrospectively in the first set of financial statements approved for issue after their discovery by restating comparative amounts for the prior periods presented. But if errors occurred before earliest prior period presented, entity should restate the opening balances for earliest period presented. However, there are certain limitations on retrospective restatement and disclosure requirements in respect of prior period errors. But do not worry, because you can find para by para analysis, flowcharts, and numerous examples of this as well as other Ind AS on our e-learning platform. We hope this video could help you grasp the basics of Ind AS 8. Before you move on with your day, don't forget to visit our website and master Ind AS. Till then, keep clicking, keep learning.